Hey people, thank you for stopping by at Building Wealth with Achieve. How are you doing? Trust all of you are fine. Here's my chat with Victor. Victor is based in Silicon Valley. He's an entrepreneur and investor. With Google, Snowflake, and Apple in his backyard, he has phenomenal investing track record. He's been investing since 1992. He started from very humble background though. Victor and me chat and decode a couple of things. Number one, his investing track record from 2017 to 2021 in 5 years, his stock returns are in excess of 1200%. How did he do that? How did he choose companies? Number two, like most of us, he's seeing huge drawdowns in his portfolio. How is he managing through this bear market? And number three, what are his lessons? What has he learned from this specific bear market since he has been investing since 1992? I hope you enjoy the chat. Please do comment. I read all your comments and try to reply to all of them. If you like my channel for such things, please subscribe.
But the basic premise is that it doesn't matter how good my companies are; they have all taken a huge bath. And if you had talked to me literally 6 months ago, I would be telling you about my 1,500% returns in the last 3 to 5 years, and how those companies have just gone through the roof. And now we're looking at every single one of those companies and many other. I mean, Netflix is down 70%. When Netflix is down 70%, Apple's the one that hasn't been hit too hard, and it's only down 27% or 30% right now. Everything's down, but most of the SaaS companies are down more than 50%, so 50 to 70%. It's the single largest drop I've ever had to go through personally since 2000. And I invested through 2000. I started investing in 1992, so I was there. And shame on me. For those who haven't been around that long, 1993, 2000, 2008, 2016, and now 2022. Every 7 or 8 years, there's a major flip, a major recession, a major downturn, at least in my life since I started investing. And I did not time this market. I've always said I can't time the market. I just try to invest in great companies and try not to over leverage myself to the point where I'll have to sell at the very bottom because I've margined or borrowed money and they're making margin calls. So the key is to hold on. And I can't stress that enough. And that's the one thing I want people to learn right now if you're starting to invest is this one thing. That all legendary investors, and let's just look at Warren Buffett again. The one thing he has, he's not the guy who has made the most. If you're just looking at CAGR, compound annual growth rate per year, he is not the best investor in the world. But the one thing he has, and every other legendary investor in history has that others don't, is that they've stayed alive. They've survived every one of these drops. Warren Buffett will even talk about his many 50% drops in his portfolio, but he stayed alive. And I'm 53, and one thing I love about Warren Buffett is he made over 90% of his returns, of his net wealth right now, he made after the age of 50. After the age of 50. So I figure I'm just starting. I'm just Warren Buffett at his very, very beginning right now. And I think I'm probably ahead of where he is or was at that time. Hopefully, knock on wood, I have another 40 or 50 years to go, and then maybe I'll catch up.
I'm sure. And I hope to chat with you 40 years from now, talking about your investments and looking at that compound interest magic. Okay, so I think I divide this equity in two parts for you. One is your 1,500% returns, and one is the time now. So talk about what's your top two holdings, and why were they there, and how they flourished through.
Yeah, absolutely. My top two holdings right now are Datadog, which is do you want me to kind of go through my criteria for why I picked that, or how would you like to kind of address that?
Just talk about a couple of the 20 criteria might be a little bit too much, but talk about few of them which made you select Datadog, and what kind of gains you made on that.
Yeah, so generally my three top companies right now are Datadog, Snowflake, and Zscaler and Net. So those kind of four companies are four of my top holdings. Among my criteria, I try not to hold more than about 20% in any one company, and I only own about 10 companies. So, the entire list actually right now is only 8 companies long. It's not that large. One of my favorite things that I like to talk about with each one, and is particularly true with each one of these, is that I like founder-led companies. I like companies that the founder who started the company is still the CEO and chairman of the board, and he's the one doing it. And I created a little acronym called Management Flesh, FLESH, and it's basically just founder-led, experienced, shareholder-friendly, and honest. And those are each one of those is absolutely critical in and of itself. And I could talk about each one of those, but founder-led, experienced, shareholder-friendly, and honest. I can't stand listening to an earnings call or and hearing somebody say something that isn't true, or saying something that's deceptive, or changing the metrics because this particular quarter, those metrics. And having sat on a whole bunch of those and done a whole bunch of those earnings calls every single quarter in the public world, I know how it's the number one best way for anyone listening to this to understand what a company does, and to listen to the actual voice of the individual. Often you get to see their face, you get to see their investor presentation, and immediately within it's exactly 1 hour, and the last 20 or 30 minutes is just individuals, analysts asking the questions, and they often delve into the questions that you would want to ask yourself, and you really want to listen to how they react to the call. They'll either be 20 out of 20 guys will congratulate them for having done amazing, or they'll be nitpicking a whole bunch of things and saying, yeah, well, what about this? And why did this go down and whatever? And you'll know exactly what those things are. And so whether it's Oliver Pomel with Datadog, Frank Slootman with Snowflake, Matthew Prince with Cloudflare, NET is the symbol for that, or Jay Chaudhry with Zscaler. All of them are the founder. Okay, sorry, Frank Slootman is not technically the founder, of Snowflake, and that is the one exception here. But the founders are still involved, and that's a critical thing. And Frank Slootman has. There are always going to be exceptions. He has a background with, having brought other companies public that you would love to see in any public company. And so, and he has a lot of charisma, and he leads the company really, really tightly, and I love it. So founder led is one of those. The things that I'm looking for, obviously, by virtue of the companies that I'm invested in, I'm looking for very fast revenue growth. Typically my cutoff is 50%, 50% growth. So every year and 3 quarters or so, they're doubling. That company is doubling the revenue. So really, really fast growth. And that's not just growth. And yes, we've all gone to this EV to sales ratio instead of price to earnings, blah, blah, blah. But it's not at the expense of being profitable. I want them to either be break even and reinvesting in their own company if it's very early on, or I want them to be accelerating their leverage and their profitability and their cash flow from operations and their free cash flow. And I want to see all that increasing and becoming more lucrative. And ultimately, I'm looking for companies that can 10x themselves. I'm looking for always the next Google, the next Amazon. And I'm, heck, if I get one of those right, game over. Bye-bye, Warren Buffett. I just beat you. All I got to do is find one, and I'm going to keep looking until I find it. And you know what? The reality is, I like to say, shoot for the stars, and you'll at least get to the moon. Well, look, those companies, I'd have to pull up my sheet to tell you, Datadog. Because you ask, how much am I up? I've been in Datadog for at least, I can tell you when my first purchase was, for at least 2 years. It's probably 2.5 years. And I bought into Datadog in the high 20s, low 30s. So that's just one. I bought into Cloudflare The first purchase of Cloudflare was on April 3rd of 2020, and that was at $23.94. And so, I'm not a short-term holder. I'm not trying to trade stocks. I often say leave the trading to the professionals because I'll never get it right. I can't time the top. I can't time the bottom. But if I'm in a fantastic company like Cloudflare, even after it's down 60%, I don't know what it is down exactly right now, but it's down 60% in the last 6 months. I'm still up 200%. More than that, I'm up 300%. So it's already it's still a triple for me. It's a long-term gain. I think it's a phenomenal company. I still think it can be one. I think it could be the next Google. It could be the next one to, and so I'm looking for companies that can, that can 10x themselves and have the TAM, the total available market, to be able to do something like that. I look for growth indicators, whether it's customer growth, product, new products that are coming out, extending themselves into other geographies, whether it's worldwide or wherever. What else? Annual recurring revenue is a huge one for me. That's one of those things. Look, when I was growing up, the first stocks that I looked at in the early, mid 90s, if it was, take Nike, you sell 100 pairs of shoes in 1 year. In order to have 20% growth, you have to start at 0 and sell 120 shoes the next year. And then the next year you got to start at 0 and sell 142, whatever the number is, shoes the following year. Every year you're starting back at 0. With annual recurring revenue, which is the model of most SaaS companies, you basically have that revenue guaranteed. And so when I can find companies similar to Choreo that I took public that have 3 to 5 year contracts already in place, guaranteeing that I sell 100 this year. Okay, well, that contract's already in place. I start at 100 next year, and I'm going to, and I only have to sell 20 to get that 20%. Sell to 20 new customers or 20% more customers in order to get that 20% growth. So it's guaranteed for the next year. You already have it pre-sold. So that's just a few of the ones. I also look, I also look for U.S.-based companies typically, and while I make some exceptions, I've been stung 3 times with companies in China, so I don't make any exceptions. I don't invest in any companies in China anymore until the United States enforces the requirements gap that our companies have to use and disallows so many things that are mainstays in the Chinese companies, whether it's co-ownership of your brother's company and selling stuff back and forth and financial statement or whatever.
All the time.
I have to stay away just because I've been bit 3 times. I thought, oh, China, it's the Holy Grail. It's the new West. We got to be there. And yeah, I made my mistakes. And so I stay away from it. Luckily, I have no shortage of great companies in my backyard. So
yeah, so I think it's amazing to hear your thought process on SaaS. And have you how satisfied? I think Snowflake hasn't come out with earnings yet. I think Datadog has, right?
Yes, absolutely.
And Net,
yeah.
I don't know whether Net has come out.
Yeah, Net, Datadog, and Bill all came out with earnings on the same day.
So how are you satisfied? Are you satisfied with the earnings they have come out with?
I was very satisfied with Datadog's earnings. They crushed it. They raised their guide. They have insane future cash flow of like $130 million. They're above $500 million a year. They have they're GAAP positive. While they only had 1,000, the only tiny glitches that I heard or saw was that they only had 1,000 customer ads, but their NRR is going up, and those customer ads are getting bigger and bigger and bigger. And that's what you want to see. Ultimately, they're going to capture all the customers, but you want to see them continuing to get additional dollars of revenue from those existing customers, and the new customers that they're bringing in, you want to see them being bigger customers. And all those were the case. They had a small glitch with, it was net of Russian customers because they shut basically Russia down, which I'm glad that they did. But they had huge billings for their large customers. So nothing wrong with Datadog. Net, I always call it my aircraft carrier. Net, if you can look back 12 or 13 quarters in a row, and Cloud, sorry, I say Net, but it's the name of the company is Cloudflare. Cloudflare is just so well managed. It's almost on remote control. It's an aircraft carrier. It's not going through the water at 1,000 miles an hour. It's never growing 70, 80%, but it's 50, 51, 52, 53, 54, 53, 54, 55 percent growth every quarter for 13 quarters. That's 3 years. So I am actually getting excited now because I bought Net, as I just told you, 2.5 years ago in the low 20s. It's down to 58 or 59 this week, yesterday, today. And I'm getting excited because that's 2.5, 3 years, 13 quarters of 50% growth. So it's more than tripled itself internally, the fundamentals of the company, but the price is now coming back down to a price where make no mistake, and a lot of people argue it's still very expensive. It is expensive, but that's what you get when you have a company. Tell me another company that has 13 quarters of 50% growth or more. It's just sort of the battleship or the aircraft carrier. They regularly have amazing new products. I won't go into all the new products. They had a little problem with their cash flow this quarter. Normally they're cash flow positive, and and that's one thing I love about them. They had a $30 million tax payment, so I can't dock them for that. They called it out on the earnings call. It's supposedly a one-time thing. Their net recurring revenue was up 400 basis points. They raised their guidance. Their gross margins ticked up. They have a ton of new $5 million annual spend customers. It's a story stock. It's one of those companies that are going to be around. They have their tentacles in a whole bunch of stuff, and it's all coming to fruition at the same time. And they're partnering with all kinds of amazing companies, and I just see them doing really well. So while they didn't
Matthew
have
Prince
a
is
blowout,
Matthew Prince is very active on Twitter. I see his thing. He's very transparent.
He's very transparent. I love Matthew Prince. Again, back to back to my flesh, honesty and well run and founder led. Love Matthew Prince. The third one that came out that day, I wasn't as enamored with, and it isn't that they came out with bad earnings at all or anything. Bill.com is a very small. It was actually the ninth of 9 investments, and I only had a 4 or 5% position in the company, and I was just they didn't do as well as they have done in the past. They didn't show acceleration. They have some challenges right now with their reporting, which I'm always very nitpicky. And when they acquire a company, they have acquired a company called Divi, and are adding that revenue in. And I want to and so you're trying to parse it out and see, okay, how much does the new company add? And sometimes companies throw it into one company and try to show, hey, we had this much growth, and it really wasn't that much growth. It was inorganic, what I call inorganic growth. It was them adding this other company. I want to see what was the organic growth, and then what would it have been had you that after adding this on. And so Bill, in any 6 months ago, the results that Bill had would have been totally fine, totally solid quarter. There wasn't anything wrong with it, per se. They probably would have gone up after hours. In this case, they got absolutely demolished. And that's a sign of the times. Every company, every investor out there right now is looking for, they want profitability. They want earnings. Bill isn't going anywhere. If you have, I always say, and you should plan to be in every company for at least 5 years. If you have 5-year time horizon, you're going to do fantastic with Bill, and it'll be back where it was. And if you didn't own it before this, it's probably a great buy right now at these prices. So, but they were the least impressive of the ones that of the earnings calls that I looked at.
You're waiting for Snowflake.
I am waiting for Snowflake. Snowflake is
25th of May or something.
That is correct, 25th of May. So they're on the 25th of May. Monday is on the 16th of May, so they'll come out actually next week. That is my one non-American company, and that is a
Monday is Israeli, right?
It's Israeli, exact,
Yeah.
absolutely.
Yeah.
And that's a very small holding. I want to be very clear. It's it's a 3% holding for me, and I love the space. They compete with Asana, and but they're faster growing, and they're profitable, and they were cash flow, and they're doing, and I think they're going to go do well. But in a recessionary environment, when you're looking at the companies that are absolutely required, that a company won't give up no matter what, they might not be it. Nobody's going to say, oh, CrowdStrike, I'll just put you on hold for a year while the Ukrainian war is going, and if somebody attacks us, it'll be okay. No, but with Monday, it's teamwork and stuff like that. And I apologize. My
okay.
dog might bark here in just a moment because the FedEx guy's coming over. But so sorry.
Yeah.
Anyway,
yeah,
that is so that's kind of where I'm at on those things. And I think there's a lot of lessons to be learned in the market that we're in right now.
I'm going to come to that, Victor. But
okay.
a couple of questions I have. I think that lessons are very, very important because it has caught everybody's balls.
Yeah.
Two questions I have, and I asked this same question to Bear also. I remember. These companies are not continue to grow at 50%. They will not. What will you do?
No,
then?
They will not. They
then
cannot.
What will you do then?
I look for companies that are growing in excess of 50%. Snowflake's currently growing over 100%. So will it slow down? Absolutely. The law of large numbers and all kinds of other things, they can't continue to grow. They also don't have the recurring revenue. They have a data. They're basically selling data analysis, and it is a completely different style of model. When they start to slow down, that's when I start to, look at them. Why are they slowing down? Are they slowing down but becoming a mature company and becoming more profitable and becoming, So there are extenuating circumstances. But when it gets down to a certain point where they start to drop either precipitously quarter over quarter, because you expect some slowdown in growth when there are very few companies. Zoom, which we're on right now, had phenomenal growth, some of the highest I'd ever seen quarter over quarter, for a very short period, for 3 or 4 quarters. But then what's happened is you catch up with the prior year, and then you're comparing to the prior year, and you can't have 1,000% growth over the 1,000% growth from the quarter of prior year. So to answer your long answer to your question though, Rajiv, was that you can't expect them to do that forever. But you get in them like you get in a great company like Cloudflare, who has done it for 12 or 13 quarters in a row, or Datadog, who has done it for I don't know how many quarters in a row without pulling up my spreadsheets. And I have spreadsheets on every single one of them that go back to the day they turned public. And then I use the S1 to basically put in the quarters prior to going public, because they usually give you 4 or 8 of those quarters to put in. And so you kind of have a track record of how they've been doing. You kind of track them. So I try to get them when they're on the steep part of that S curve, when they're accelerating their growth and they're going up. When they start to level off, I want to see how they're leveling off. I want to see, are they acquiring other companies? Are they market leader? Are they doing whatever? Do they still at that point have the ability to 10x themselves? And shame on me. Cloudflare, I like to preach that I don't look at the stock price, but you have to look at the stock price. Cloudflare was at 200. Okay. So when I bought at 23, I was praising Cloudflare because all of a sudden it went from 23 to 200. All of a sudden I have a 10x. I already had my 10x, and can it 10x itself again? I think the company internally can, but I think the stock price would have been very hard pressed. And so I probably should have, and I did reduce a little bit. I sell as it goes up, mostly because I don't want it to get over a 15% position, or, it starts to, when companies go up that much, inevitably they become a much larger piece of your portfolio. And so coulda, woulda, should have gotten out of a little bit more of that up at the heights, but it is what it is. It's still a fantastic company, and I haven't seen it starting to slow down. In fact, it releases more products per quarter than any other company that I own.
So the moment they come into, let's say, 40% range, you'd get rid of them.
Often I'll get rid of them before that because they've been dropping down to that point. But I'm also constantly analyzing them against 20 or 30 other companies that I have on my sort of wait list. So I have a list of companies over here that I've done, a small amount of analysis on. I know the basics of each of them, of their financials and fundamentals. And when I see them start to accelerate and I have a company that is decelerating, I might swap the two. And that's the nature of the game. Datadog didn't start off as my single largest holding. I'll buy positions in 3, 4, 5, sometimes even 10 different purchases over a period of time. And each quarter that they perform and do well, I'll add to that. I might buy additional shares to increase that position. And then you inevitably end up owning and ranking your stocks like the number one position. Datadog is my largest position. It happens to be, I think now it's about 20%, not because I bought more, but because it has relatively held its performance while some of the other companies' stock prices have dropped recently.
But the thing is, Victor, these damn valuations, don't they bother you? I mean, look, right now,
Absolutely.
I think everybody's humbling. Everybody's got humbled. Yeah. Whether it's Snowflake or, I'm not, God knows what's the right valuation. I mean, this valuation is one of a very sticky topic in my head. I mean, I'm not experienced as successful as you are, but, it remains a topic in my head where I have no answers to most of the time.
Yeah.
But Snowflake at one time, like what, price to sales 70, 75, 70. Now I think it's 38 or something.
Yeah, and that's still very high.
Didn't that bother you?
Yeah, it does. It does bother me, and I try to take it into consideration. It's why I dropped a little bit. I decreased my net when it hit 200, my Cloudflare position when it hit 200, over 200, because that valuation was extremely high then for this company. And I just thought, it's growing at a 50%-ish rate versus Snowflake that's growing at 100% rate, but Cloudflare was up with Snowflake. That doesn't make sense to me, and that's important that you understand that correlation, and that a company that's growing 50% it should not have as high a valuation as a company growing 100%. All of the things being equal, in this case, Cloudflare was, and so I reduced some of my Cloudflare to buy Snowflake. I just felt that it was a good swap. But I hear you, and I mean, it's great you bring it up. For probably the last 5 years, even in 2016, which was a big drop, me and a few people, we all felt like Superman. We felt invincible, and all of us are eating the biggest piece of humble pie, we call it in America, humble pie, that we've ever had to try to swallow. And it's not easy, and you start to second guess all of your convictions. But the flat out reality is a company like Snowflake has the ability to 10x itself. And a company like Snowflake is, you look at what they're doing.
From the current prices you're talking about, has ability to 10x?
Yeah, sorry, from their current prices. And they're down, or I don't know exactly where are.
They're hugely down. They're about 60% down from the year end, or 70%.
No, but I'm talking about from their IPO price, and they've only been out a couple of years, not even a couple of years. With COVID, I always lose 1 or 2 years because I kind of blip that all together as if it didn't happen. I'm trying to find my first purchase of Snowflake, which was whenever it was. It was back in 2020 or 2021. But I think it is actually below where it went public now, and that's how many quarters? That's 8 quarters or 10 quarters after 100% triple-digit growth every quarter. So they're that much bigger, have that many more customers that are not going anywhere. I mean, they literally are they're clearly the market leader. I wouldn't say that they're the only company out there doing this. A lot of companies are doing it, and some of the bigger tech companies are trying to figure out how to do it without Snowflake. But they've basically partnered with everyone, and they're incredibly well positioned to continue to grow both internally. And the bigger story, it is a story stock after all, is that 5 years ago, we digitized more information than they had done in the rest of history combined. And then 4 years ago, we did it again, including that prior year. And then 3 years ago, we did it again. And 2 years ago, we have so much information that we're literally drinking from a fire hose, and we don't know how to, we can't digest it. We can't even get a drink of water because it's hitting our face so hard that it's punching us in the nose. Companies like Datadog, CrowdStrike for the security, Snowflake for the analysis, are allowing you to take that data, put it into data lakes and data ponds and data. They always call it something with water, data oceans and data blah, blah, blah. I always laugh at the words and names that they come up with for everything. And be able to cross-reference it and then sell it. And you can take your data and you can combine it with just the data you want with just the data that another company wants. And then you guys can use that data and charge each other for it. And then you can put it into another lake over here that a bunch of other companies can go. And I'm not a techie. I don't have the background of that. I have some very dear friends who are incredible at that. You may know Muji, for instance. Yeah, Muji's one of them, and he and I were fortunate to get 5 days of skiing in, and he's a phenom at that. And I highly recommend you look at his blog and his newsletter. It's if you really want to understand what a company does, he'll go so deep that it'll make your head spin. And I'm constantly trying to keep up with him, which I love. That keep learning. That's the only thing we can keep doing until the day we pass. So yeah.
Yeah. So for you, the valuation is relative. It's not absolute. That's how I'm looking at you, because you compared Snowflake and Net, and
It has to be. It is relative on some level, and then you also just have to. It's going to be dependent on the company that you're in, and and don't get me wrong. And I'm sure there are a lot of people that may listen to this and totally want to just hit me over the head because of what has just happened the last 6 months. They were by any stretch of the imagination overvalued. The entire sector was overvalued. You look at a historical analysis. You look at some of the original SaaS companies like Salesforce CRM. It should be somewhere in the high teens. Maybe it should be 15x. Maybe it should be 20x. Who knows what it should be? I don't think anyone can actually say. You also have to look at the story behind the company. And like I said, these 20 other factors that I'm looking at. I don't just look at I try to keep the valuation in the back of my mind and keep in mind that has it been bid up too high to where I don't want to get in it. But if that were the case, I would never have bought Cloudflare at 23, because even then, backtrack 13 quarters of 50% growth, it was way overvalued, right? So you would never have gotten into that. Same thing with Snowflake. Compounding, the magical compounding you referred to earlier, is a phenomenal thing. And what is the number 8 or 9% that doubles every 7 years? Well, what does 100% double every 7 years?
Yeah.
Not that it's going to continue for 7 years, but if it does that for 3 or 4 years and then continues at a very fast clip, and the amount of information that's being digitized is not slowing down.
Yeah.
So somebody has to handle that information, and all of the things being equal, we've had every 7 or 8 years, we've had this drop. I think anyone out there should be super excited right now at some of the valuations and some of the values that you can get that you would have had to pay a lot more for just 3 months ago, 6 months ago.
Tell me one thing. How does it change for you now? Huge success in 5 years, and now I think it's like somebody slapping you every day, badly. That's what market is doing.
I wish it was just slapping. I feel like somebody is standing there with a paintball gun, if you know what that is, and just shooting me right here in the forehead over and over again.
It's very, very painful. How does it? First thing, what are your lessons now? What did you learn? What did you think you did wrong and you wouldn't repeat?
I think, one of the lessons I think we humans often learn over and over and over again is how to be humble, how
Okay.
to realize that you're not infallible, and that how to, and to remember that no matter how much you think you know, there is so much stuff out there that you don't know. And what we do know is all biased by what we knew prior and what we paid attention to. And we could be completely missing the forest for the trees. And I underestimated, not that I ever would be an advocate. I always say, don't try to swim against the tide. And we've had an ebbing tide, but I underestimated the power of the fundamentals of my underlying companies compared to the Fed shutting off all the spigots, raising the interest rates. I didn't think that it would have this much of an impact this fast. I didn't think all those things would happen. Certainly didn't register that there would be a war in Ukraine, that inflation would go this quickly from whatever 1% to 9%, 8.5%. I think it topped out at 8.5%, and now it started to tick back down. And so there's sort of a perfect storm. But unlike the .com, when they had no revenues, I mean, these companies had no revenues. Not mine. Mine was, again, cash flow positive and so forth. But they had no revenues. Or not like 2008, when you knew the financial crisis was like, oops, I'm out. Like literally one day to the next, I completely exited the market. I knew that I needed to just get out and wait this out. And I was very lucky. I waited about whatever it was, like 4, 5, 6 months, and then got in within 5 days of the low. I can't time the low, but as soon as I felt like it was way overdone, I bought the only 3 banks I've ever bought in my life: Wells Fargo, Bank of America, the ones that survived, Bank of America and US Bank. And I bought them all below $10 and watched them go back up, because I thought, this is ridiculous. The government's already stepped in and showed us that they are going to save the banks going forward. They had let a couple of them fail. And I knew that it was going to, but the point being, I knew it. This one, there wasn't really any grand notice. You don't really know what the Fed's going to do. There was no announcement that we were having a financial crisis that was going on. And all of a sudden, all this happens. And so I've been humbled, for one. It reiterated the importance of one of the criteria that I always go by. It's like, you have to be able to survive through it. So don't over leverage, certainly not at the top, and make sure you have some funds on the side. You need to have a couple of years of living expenses on the side, so that if everything goes sideways, you're not going to go under and have to sell everything right at the very bottom to fund building your house or doing whatever. And that's super important. And I'm also really fortunate, and I tell people, I don't invest every penny that you're going to need in the next 2 to 5 years. Invest what you don't need for 5 years. And if you can do that, and I'm fortunate that I've also done a lot of real estate investing in my life. I started really young, and talked a buddy of mine borrowed money from my grandmother and maxed out a credit card to buy a house in the Silicon Valley. And then I got 2 roommates to help pay the mortgage of the house. I was 24 years old at the time, and leveraged that to build up sort of empire. So I have the diversification, even though most of my companies are software companies, SaaS companies, technology companies. One would look at that and say, oh, you're not diversified. I also have a conservative investment. I have, both commercial, residential, real estate that I have mortgages on, but that I can rent out. That is a very safe, relatively safe investment. And the amusing thing is 2008, I watched them all get cut in half. It's all paper. I didn't have to sell the house. I had someone renting the house, so I just held it. They've all come back, and they're way above the prices where they were in 2008 at the very height of the financial, before the financial crisis hit. So, have some diversification, have some funds on the side, and make sure that you can survive through it. Warren Buffett wouldn't be Warren Buffett, and Charlie Munger wouldn't be Charlie Munger if they had gone under at any point in their investing career, or if they had stopped using that number one thing that all legendary investors have, is time. But they had to first and foremost survive through that difficult period. And kudos to Warren Buffett. He was sitting on a ton of cash, and is now buying.
Now. He's
and now
buying.
is buying companies. He's now buying companies, entire companies, and Yeah.
So I think before we end, two more questions. I'm loving this conversation, and I can go on for hours. But in this interest of time, two questions. One thing: would your strategy change? Would you still keep owning these SaaS companies with these lofty valuations and lofty growth? Because your portfolio is concentrated in the high beta portfolio, isn't it?
It is. It is. So there's a lot of factors involved here. One is I don't think I have 5 years. I think I have 25 years.
Okay.
While I'm already well over 50, I don't consider myself old, and I feel like I have a lot of time on my hands to be able to, to last through these things. Number one. Number two, again, I'll repeat, if you own a stock, you should be listening once a quarter for 1 hour. It takes 4 hours of in an entire year listening to the earnings call and reading the earnings report, and just try to digest it and understand it and track some things and see how they're doing. If you're doing the most basic of things, and you have a fundamentally sound company with enough cash on the balance sheet to survive, and every one of these companies that I've talked to has it's not even millions. It's in some cases hundreds of millions, and in many cases it's billions of dollars that are sitting on their balance sheets. They're not going to go under tomorrow. So like you want to have some money on the side to survive as an investor, the company has to have money on the side for the difficult times, the recession that might come along. And if they can get through that, they're going to come out much stronger on the other end. And so, yes, I have a high beta portfolio, but I also have a very, very, very low beta portfolio in real estate and in various other investments. And I also do a small number, less than 10 private investments as well. So I'll, in a VC style, where basically I'll analyze companies or have opportunities to invest in small pre-IPO or companies that aren't even going to go IPO. I just own small pieces of them, or I sit on the boards where I've gotten equity for a piece of the company. And so, I have some, so things go. So it's not like I'm relying on just those 8 companies, but that's what you wanted to focus on the high beta companies. So that's what I've focused on so far.
So I think you have a cushion. That's why you can afford it. Had you not been having cushion, you probably would be thinking differently. Is that or
no? I'm thinking that way anyway. I'm still thinking it's very, very highly leveraged. I'm also wondering, I'm asking myself the same question. I think 3, 4, 5 years into this, you do get a little bit deaf and dumb to the valuations that some of these companies have, and you start to buy in a little bit to the CNBC jabber that says, just buy it, buy at any cost, whether it's Kramer spouting, and then now he'll say the opposite, but whether it's Kramer or whoever. And I don't watch a ton of CNBC, but I'll flip it on every once in a while at lunchtime and watch an hour of it, and you start to hear about these companies, and people start to forget about the valuation. They forget that, oh well, yeah, we're at 30x, 50x, 70x of just, if you're just looking at an EV to sales, and you do have to be careful with that, and balance that with, okay, what kind of growth do they have? I mean, I am, what am I doing right now? I basically went from the 10 companies to 9 to 8. I've dropped Bill.com just because I'm trying to take the best of the best companies I have and ride those back up, and the ones that I think are going to continue their growth and have the best potential to double, triple, and quadruple. And I'm not ever talking about the stock price. I'm talking about their internals. They're going to, I call it the dog and the tail. I invest in the dog. Eventually sometimes that tail may be between his legs like it is right now. Other times it may be wagging high, but eventually if that dog is going up the hill, that tail is going to follow the dog up the hill. If the dog is going down the hill, eventually that tail is going to follow the dog down the hill. So, I try to invest in the dog and let the tail do what it wants, the tail being the stock price.
And last question, are you buying now?
I have added to some of my positions with the very small amount of cash that I had on the side. I'm being very careful not to leverage myself because, who knows? Could we go lower? I wish I could tell you guys. I wish I would tell anyone. I would not have guessed that we'd be going this low in this particular downturn. I mean, we've had 5 35% drops in the last 5 years, and I've ridden each one of them out and reinvested and gone up. And so and I thought this was going to be something more akin to that. I wasn't expecting it to drop more than that. And now we're looking at 60% down on the portfolio. So it's a very tough pill to swallow. If you get over leveraged, it's a double-edged sword. It's great on the upside, but if it continues to go down and you're leveraged and you get a margin call and have to sell when it gets to the bottom, who knows where this market, it is obviously a lot of emotional trading going on right now. I'm emotional about it at times. I'm like, how can some of these companies be trading this low? They're back where they were 3 years ago, and yet they've had, they've quadrupled their size. They're much better positioned. They've raised money. They have, all cash, no debt, this, that, whatever the metric is that you're tracking. It makes me excited going forward, but it makes me fearful of leveraging, margin trading, borrowing money to go in. I'm not throwing everything in. I think we'll know when it hits the bottom, and we'll have plenty of time to catch it on the way back up. So I'm trying to be prudent and careful because I do have some projects going on in real estate that I have to be able to fund. I do have things that I have to be able to make sure that I have the funds to do. As I told you at the beginning of this call, I have a kid in college and another one going to be starting shortly. So I have to be careful that I have those funds set aside and or able to access. And so I caution everyone to, don't just plunge everything in because you think we're at a bottom. We don't know where the bottom's going to be. And it could go another 10% from here, maybe 20.
Thanks. Yeah, nobody knows, Victor. It's anybody's guess. And if we go into recession, how long will it go? It's a bad situation. I think we got to have caution, and
it can go sideways forever.
Yeah, it can go sideways for years. We never know.
Yeah.
So I think on that note, Victor, thank you so much.